Hey, welcome back, and thank you so much for joining me in today's video because average mortgage rates on Friday just increased to a 2.5-month high, which is absolutely insane, rising above 7.1%. Yet, home prices posted the biggest annual increase in about 15 months, according to the latest report from Redfin. In today's video, I'm going to provide some early indications of home buying demand, some early factors that could impact sales and prices in the next 2 months. But I'm also going to touch on what's happening right now regarding prices, pending home sales, inventory numbers, and much, much more. And again, thank you so much for joining me in today's video. If you guys aren't subscribed just yet, I invite you to do so because I post frequent housing market updates based on data so you guys can be more informed. Let's begin today's video. This was posted on February 15th from Redfin here. It says home prices and rates rise, pushing would-be buyers to the sidelines. Leave me a comment below if you guys are waiting for home prices to decrease and for housing to become more affordable. That's a big, big challenge. Gosh, I've been talking about this for what, over a year? Rising prices and rates causing housing affordability to be a giant issue here. So according to Redfin's economic research lead, she stated the following: the Super Bowl is like Groundhog Day for real estate economists. We usually have a read on how the market is shaping up by the beginning of February. And the read this year is that it's looking sluggish so far, mostly because of stubbornly high rates. I'll share some stats regarding that here in a little bit. This week's hotter than expected inflation report, there's actually two reports. One posted, I think it was on Wednesday, and then one posted on Friday. And again, I'll share that with you as well. But because these hotter than expected inflation reports, this confirms that the Fed is unlikely to cut interest rates next month, which means rates will stay near 7% for now. I would say that there's basically a 0% chance that the Fed will decrease the federal funds rate in their next meeting, which is actually in March. And actually, to be exact, let's have a look at the Fed Watch tool. This is from the CME. So this is basically a snapshot showing the likelihood of the Fed to decrease rates or change rates in their next meetings here. So their next meeting is scheduled for March 20th. This is pretty wild here because right now, the federal funds rate is at 5.5%. So in their next meeting, the CME group here is calling for the Fed to pause, in other words, not to increase or decrease rates in their next meeting, at least by 91.5% probability. This is much different compared to 1 month ago, though, because everyone 1 month ago was saying how the Fed was going to pivot. We're going to see rates going down to 5.5% for mortgage rates here very, very soon. But that seems highly unlikely anytime soon, given the hot jobs market or the reports we have on that, and also the hotter than expected inflation reports as well, which I'll share with you guys in a little bit. So 1 month ago, the street was forecasting by a 63.1% chance that the Fed was going to decrease rates by 25 basis points down to 5.25%. Now it's only 8.5%. Also, 1 month ago, the decrease in rates down by 25 basis points was only at 35%. Now it's at 91.5%. So investors are flip-flopping here because they're saying here that we're having all these all these reports that are being announced that is really decreasing the chances that the Fed will pivot anytime soon. In fact, look at May. May, 5.5%, a 65.8% chance will be at the same rate we have today. But then in June, things a little bit change here, right? So they have a 51% chance that the Fed will decrease rates by 25 basis points down to 5.25%. So what does this all mean? This means that we'll likely have higher mortgage rates for longer than what was previously expected here. And that's exactly what we're seeing right now. In fact, let me just share the rates as of Friday. So as of Friday, the average 30-year fix, again, this is for people with exceptional credit buying their first house. they're putting down at least 20%. So if that is not you, you'll likely see higher rates than these average national rates based on this daily survey that they do here. 7.14%. For a jumbo, 7.4%. And also for VA and FHA, around 6.5 to 6.7%. So the average 30-year fix, again at 7.14%. Again, this is a 2.5-month high because the last time we had rates this high was way back in November 30th last year. This is also a fairly big increase in a short period of time as well, because over the past 2 weeks here, rates have increased by about a half a point or about 50 basis points, because 2 weeks ago, approximately, the average rate was at 6.63%. Also, according to Freddie Mac, as of Thursday, they look at weekly rates. The average weekly rate increased to 6.77%. And according to their chief economist, he stated the following here. On the heels of consumer prices and also producer prices rising more than expected, rates increased this week. The economy has been performing well so far this year, and rates may stay higher for longer, potentially slowing the spring home buying season. We tend to see a huge uptick in activity regarding new listings and also pending home sales, as well as sales in the spring home buying season. But if rates stay at these high levels, over 7%, that will likely take the wind out of the sales per se here. According to our data, applications for mortgages to buy a house so far in 2024 are down in more than half of all US states. So why did rates increase so much this week? And this is the answer right here. Here's a really good website I look at, not a paid promotion, but I look at it on a daily basis here. It is investing.com, their economic calendar. Just Google that. Also, I'll provide a link in the video description below as well. So what happened this week, which caused rates to increase? That's because we had two inflation reports that actually came in hotter than expected. The first one came on Tuesday, February 13th. That is the Consumer Price Index, or the CPI. The core CPI, which excludes volatile energy and food prices, rose by 0.4% compared to December, which is higher than expectations of a gain of 0.3% and also higher compared to the previous month as well. On top of that, the year-over-year change increased to 3.9% compared to the 3.7% that was expected. And keep in mind here, the Fed wants the inflation numbers to be at 2%, not at 3.9%. A huge issue if you guys want to see rates decrease here. Also, we have this as well. Initial jobless claims. This is people applying for unemployment benefits for the first time. That was at 212,000, lower than expectations of 219,000, also lower than the previous month as well at 220,000. Also, the previous week was at 220,000, so this week lower than the previous week as well. Some mixed news this week though, because retail sales decreased a whopping 0.8%. I say whopping because the street was forecasting a decrease of 0.2%. And also, this is much worse than the 0.4% we saw in December. On top of that, on Friday, on the producer side, this is the PPI, core PPI, excluding food and energy costs, which tend to go like this, are very volatile. Core PPI increased by 0.5%. The street was forecasting only a gain of 0.1%. Also, this is much hotter than the previous month, a decrease of 0.1%. So for all these reasons, this is why we're seeing a rise in rates, because we're not seeing inflation winding down, or we're not seeing the labor market implode, which frankly, that's what the Fed wants to see, right? They want to see the inflation numbers come down. But because inflation numbers are not coming down, the likelihood that the Fed will start decreasing rates, which has an indirect relationship to mortgage rates, that's not going to happen anytime soon. In any case, let's get back to Redfin's report here, because they talk about some more early signs of home buying demand. And two of those factors, actually three of these factors, are three things I also track as well. That is applications for home loans to buy houses. decreased by 3% from 1 week ago and was down 12% year over year. Also, Redfin's Home Buyer Demand Index, that's an index they have which basically measures the amount of interest for or from home buyers by their Redfin agents, requests for home tours, and other home buying activity. That was down 6% from 1 week ago and also down a whopping 18% year over year. Also, people searching for homes for sale on Google fell 11% year over year. Now let's talk about prices here. Basically what Redfin does, they track approximately 400 plus US metros to see how the numbers have been changing over the past several weeks here, or months and weeks. So they look at data that goes back through 2015. The most recent data we have from them is for the 4 weeks ended February 11th here. So the median sold price came in at just under $363,000. That was up by 6.1% year over year, the biggest increase since October of 2022. Now here's a snapshot looking at just that. So the orange line right here is 2024. This year, the blue line right here is 2023. The black line is 2022, and here's 2021 at the bottom. Look at that, just 2 years ago, the median sold price was just under $300,000. Now it's at $363,000, an increase of about $60,000. And also keep in mind, back in early 2021, you're looking at an average rate at around 3% for an average 30-year fixed mortgage rate. Now it's at over 7.1%. So not only are we seeing a huge increase in prices, but again, huge increase in rates as well, which is causing a lot of people to be on the sidelines. And that's why we're seeing a lack of transactions. We saw that last year. Last year as a whole, we had the fewest number of home sales since 1995. A housing crash of home sales last year, to say the least. Any case, we're seeing right now is more or less what we see typically during this time of year. We're not seeing a huge increase in prices just yet because we're not during the spring home buying season right now. One thing I noticed is that last year in 2023, at this time, home prices were only up by 1% compared to 2022, whereas this year we're up by 6%. But it's not the crazy gains we saw back in 2022 compared to 21 though, because at this time in 2022, we were up by 14%. Also in 2021, compared to 2020, we were up by 14%. Our housing market was surging, to say the least. I also want to share the prices for each of the 50 biggest metros that Redfin tracks as well. So there's only 3 metros out of the 50 that have decreased on a year-over-year basis for the 4 weeks ended February 11th this year. The 3 metros that are down are all located in Texas. Now, this is something new here. Look at this. San Antonio, Texas, down 5.2%. Austin, Texas, only down by 1.4%. Austin, Texas was in the #1 spot here, the biggest loser nationwide for months. I can't remember last time that Austin, Texas was not in the #1 spot here. Anyways, we had San Antonio, Austin, and then Fort Worth, Texas, all down year over year. But Fort Worth is actually getting very close to being in positive territory. In any case, the biggest increases year over year were actually in Newark, New Jersey, up by 14%. Then we have New Brunswick, New Jersey, Miami, Anaheim, California, and Warren, Michigan. All right, changing gears slightly here. Let's look at the average monthly mortgage payment that would-be home buyers would be incurring if they were to buy a house. This looks at what was the median asking price. So these are houses actually for sale. What's the median asking price compared to the weekly rate 1 week ago? Remember, 1 week ago, rates were much lower than they are today. So for example, the median mortgage payment, monthly mortgage payment was just over $2,600 per month at the 6.64% rate. That was actually 2 weeks ago, because this week, according to Freddie Mac, it's at 6.77%. 1 week ago, it was at 6.64%. I mentioned that because this number right here, a gain of 9.1%, will likely be much higher next week once they report the latest numbers and also once they update their interest rate here. But in any case, when we're still at a lower rate or a much lower rate than we have today, that's only down roughly $110 per month from the all-time record high that was set back in October 2023. Meanwhile, let's talk about pending home sales, new listings, when a house gets listed for sale, and also active listings, which is the total number of houses actually for sale or house inventory. Let's first talk about pending home sales because that decreased by 7.3% from 12 months ago. That was actually the biggest annual decline since October of 2023, excluding the prior month's period that was announced 1 week ago. Meanwhile, new listings increased by 8%. Pretty interesting here. Even though active new listings increased by 8%, the amount of contracts being signed still decreased by 7%. Part of that is probably because of this, your average monthly housing payment rising because of rising prices and also because of rising rates, but also because of this right here, active listings are still down 2.5% from February of 2023. All right, let's have a look at Redfin's data center, look at the numbers here or the charts here. Let's first look at new listings. As you can see here, the orange line is this year. New listings have been rising, which is normal during this time of year, and we're up by 8% from last year's levels. We're still well below 2022 and 2021 though. And by the way, if you guys want to see a real estate market crash, you would want to see this number right here going straight up, new listings increasing big time, whereas we want to see pending home sales decrease big time as well. Because if we do see a huge increase in supply and buyers are not buying those houses and we're seeing a huge decrease, that would mean that active listings would increase big time, which of course would greatly impact prices as well. But so far, we're not seeing that just yet, even though the numbers here do look a little bit sluggish though. And especially looking at this, pending home sales down 7.3% compared to last year, but also down greatly from 2022 and 2021. At this time in 2021, there was about 99,000 pending sales. Now there's only 72,000. So we're falling well behind the past several years here. Okay, let's have a look at active listings or the total number of houses actually for sale in the US right now at about 751,000, down about 2.5% year over year, which is last year's levels right there. At this time in 2022 though, we were at about only at 602,000 homes for sale. Now again, we're at about 751,000. So we have approximately 150,000 more homes for sale right now compared to 2022. And keep in mind here, let me just exclude 21 and 23 right here. So what happened in 2022, we had very, very low, near record low inventory levels of around 600,000 homes for sale. But by the time we hit August, we increased to nearly 1 million. So a giant increase of inventory in a very short period of time, which caused home prices to decrease greatly in the second half of 2022. I mention this again because back then in August of 2022, at about 1 million houses for sale, that was still well below pre-pandemic levels. It'd be more normal to see around 1.3 million to 1.5 million houses for sale. But even though we still had fewer homes for sale compared to pre-pandemic levels, because inventory increased so much in a short period of time, that was one of the main reasons why home prices decreased so much in the last half of 2022. And that was because a lot of people had sticker shock because rates were increasing so much, going from about 3% to about 5% in a very short period of time. And therefore, because of that, a lot of people were not listing their houses for sale. And of course, we saw a huge pullback in contracts being signed. That's why we had a huge increase of inventory levels back then. In any case, let's get back to Redfin's report here and talk about each of the 50 biggest metros regarding pending sales and also new listings. So pending home sales only increase in 3 of the metros on a year-over-year basis. This means that 47 of the 50 decrease year-over-year. The only gains were actually in San Jose, California, Cleveland, Ohio, and San Fran. In contrast, the biggest losers here was actually in Portland, Oregon, San Antonio, Texas, Warren, Michigan, Nashville, Tennessee, and New Brunswick, New Jersey. In regards to new listings decreased year-over-year in 12 of the 50. The biggest increases were actually in Dallas, Texas. New listings surged by 29%. I believe this number here excludes brand new home construction. So we're only talking about existing houses in today's video. And I know for a fact that Dallas, Texas has a large amount of new home construction there. So it'd be really interesting to see here. If we were to include new home construction numbers here, this number would likely be much higher, I'm guessing. In any case, Dallas, Texas led nation, a gain of 29%. Then we have Jacksonville, Florida, Fort Lauderdale, Florida, and also Miami and Tampa, Florida. So 4 of the 5 biggest increases were located in Florida. I'm guessing due to the giant increase in home insurance rates, or partly due to the fact they're in Florida. After that, we have a huge decrease in Milwaukee, Wisconsin, the biggest decrease in the number of new listings there. And we have Atlanta, Chicago, Portland, Oregon, and Nashville, Tennessee. Okay, changing gears slightly here to talk about the month supply. So the month supply on a national level here, according to Redfin, is at 4.2 months, up slightly compared to last year's levels, which last year is the orange line right here. And also we're higher compared to the past several years as well. So for example, in 2022, the month supply was around 2.2 months. Now it's at 4.2 months. There's 2 more charts I want to share with you guys, and that is the share of price drops and also the average sale price to final list price ratio, which is below 100% here. In any case, the share of price drops has been surging lately. The blue line is this year. According to Redfin, it's at 5.6%. 1 year ago, this time, we were at 4.5%. Also in 2021 and 2022, we're only at about 2%. So the share of price drops right now is at least a 3-year high during this time frame. And lastly, here's a look at the average sale price to final list price ratio. For the houses that did sell over the past 1 month, on average, they sold for 2% below the seller's final list price. And that ratio is at 98%. This is above 2023, when back then that ratio was at 97.7%. But this is still much lower compared to 2021 and 2023, when back then houses on average were selling for the seller's final list price. With that said, thank you so much for joining me in today's video. Like and subscribe, and of course, share this video with anyone who feel may get some value out of it. Hope you guys have an awesome day, and look forward to seeing you on the next video.